Hedge funds are the financial world's secretive powerhouses, where a single manager can rake in billions, moving more money than the economies of entire nations. These firms don't just play the markets, they shape them, shifting trillions of dollars with trades that can crash companies, manipulate assets, or spark global financial chaos. They operate in the shadows of Wall Street, constantly skirting the line between genius and scandal. Insider trading, market manipulation, even full-blown Ponzi schemes. But what actually is a hedge fund? How do they work? And how do they keep making obscene amounts of money, even when they lose? A hedge fund is not your average investment firm. It's a financial machine built to make money in any market, whether stocks are soaring, plummeting, or stuck in limbo. Unlike mutual funds, which mostly buy and hold stocks and bonds, hedge funds play an entirely different game, one where they're expected to win at all costs. If they're not making money, they're dead. And because they cater exclusively to the ultra-wealthy, they operate in the shadows, making big, aggressive, and sometimes downright ruthless moves that the public rarely sees until it's too late. Hedge funds exist to do one thing: generate absolute returns. That means they don't just try to beat the market, they aim to make money no matter what. If a recession hits, a regular investor might panic, but a hedge fund, they've probably seen it coming months in advance and already placed billion-dollar bets to profit off the chaos. To pull this off, they use every financial weapon available: short selling, leverage, derivatives, high-frequency trading, you name it. These aren't your typical buy a stock and hope it goes up investors. They're sharks in a sea of regular traders, always moving, always hunting. But here's the catch: hedge funds aren't for everyone. You can't just sign up and throw your spare cash in. You need to be an accredited investor, which means you either have $1 million net worth, excluding your home, or a high annual income. This is because hedge funds are risky, and regulators don't want everyday people getting wiped out by high-stakes financial warfare. Because they cater to the rich, hedge funds also operate with fewer restrictions than traditional funds. They can trade whatever they want, however they want, and with much less public scrutiny. The secrecy is part of the appeal. Hedge fund managers don't want the world knowing what they're doing until it's too late. They file their reports late, reveal their positions only when required, and sometimes manipulate markets behind the scenes. Their strategies are intellectual property worth billions, and they guard them like state secrets. But make no mistake, when they make a move, the effects ripple through the financial system. And let's talk about the money. Hedge funds don't just make money when their investors do, they make money regardless. The industry standard fee structure is called 2 and 20, meaning they take 2% of all assets under management as a flat fee plus 20% of any profits. This means even if a fund loses money, the managers still get paid. Let's say a hedge fund is managing $50 billion. That 2% alone means they're pulling in $1 billion a year before even placing a trade. If they make a 10% return for investors, they pocket another $1 billion just from the 20% performance fee. That's why the biggest hedge fund managers don't just make millions, they make billions. But the real power of hedge funds comes from how they operate. Unlike traditional investors who rely on things like earnings reports, revenue growth, and economic trends, hedge funds use a combination of data, market psychology, and sometimes even aggressive corporate tactics to make money. Some funds specialize in stock picking, buying undervalued companies and betting against weak ones. Others focus on global macro trends, making massive bets on currencies, interest rates, and political events. Then there are quant funds, which use algorithms and machine learning to trade at speeds no human can match. Take Jim Simons, the founder of Renaissance Technologies. His Medallion Fund, run entirely by PhD mathematicians and computer scientists, is the most profitable hedge fund in history. Instead of hiring Wall Street veterans, he hired physicists, cryptographers, and statisticians, believing that patterns in the market could be cracked like a code. The result? An average annual return of 66% before fees. If you had invested $1,000 in Medallion in 1988, it would be worth over $140 million today. But good luck getting in. The fund is closed to outsiders, and only Renaissance employees can invest in it. Then, there are the activist investors, the ones who don't just buy stocks, but force companies to change. Billionaires like Carly Khan and Bill Ackman have made fortunes by taking stakes in companies, and then publicly calling for leadership changes, layoffs, or even complete overhauls of business models. When Ackman shorted $1 billion worth of Herbalife stock, claiming the company was a pyramid scheme, Icahn stepped in, bought a massive stake, and publicly humiliated him. The battle lasted years, with Ackman ultimately losing hundreds of millions, while Icahn walked away with $1 billion profit. But not every hedge fund story ends in success. The same high-risk strategies that make some managers rich can also lead to spectacular collapses. One of the most infamous examples is long-term capital management, a hedge fund run by Nobel Prize-winning economists who believed their mathematical models could predict market movements with near certainty. They used extreme leverage, borrowing $30 for every dollar they had in capital to make massive bets on bond markets. For a while it worked, until it didn't. In 1998, a financial crisis in Russia triggered market movements that their models hadn't accounted for, and LTCM lost billions almost overnight. The losses were so catastrophic that the Federal Reserve had to step in and organize a bailout to prevent a global financial meltdown. Hedge funds live and die by their ability to predict and control market movements. Some thrive in volatility, profiting off crashes and booms. Others crumble under the weight of their own risk. And while some managers become legends, making billions and shaping entire industries, others disappear as quickly as they rose. But hedge funds don't just navigate the chaos of the market. They create it. They manipulate it. They weaponize it. Because this has never been just about making money. It's about control. And for those who sit at the top, control means power. There are no rules in their world, only advantages. Strategies so aggressive, they border on predation. A game so rigged that even when they lose, they still win. They don't gamble with their own money. They gamble with everyone else's. If a trade goes right, they pocket the profits. If it blows up, the damage spreads like a virus. Banks, pensions, entire economies left to clean up the wreckage. The hedge funds, they walk away, untouched, already placing their next bet. Short selling isn't just a bet against a stock, it's the silent execution of a company. Hedge funds don't predict a business will fail, they decide it will, and then they set the machine in motion. Analysts suddenly downgrade the stock, reports appear questioning its fundamentals. A concerned source leaks rumors of trouble. The market listens, investors panic, and the downward spiral begins. But it doesn't stop there, they pile on. Double down, drive the price lower and lower until the company itself starts to buckle. Credit lines dry up, layoffs begin, confidence evaporates, and when the final collapse comes, when executives resign and assets are sold for scraps, the hedge funds are long gone, already counting their profits. This is power. The ability to turn perception into reality. The ability to create a crisis, profit from it, and leave no fingerprints. And it doesn't stop with companies. Entire economies have been caught in the crossfire. When hedge funds see a weakness in a currency, they don't hesitate. They exploit it until the country itself buckles under the weight. Lives ruined, inflation spiraling, national economies in freefall. But for the funds, it's just another trade. High-frequency trading makes it even more predatory. This isn't about instincts or experience, it's about speed. Algorithms faster than human thought, analyzing micro-movements in the market, placing and cancelling orders in milliseconds. The average investor doesn't stand a chance. A stock price changes before their order even executes. They buy higher, sell lower, and don't even realize they're being drained. Billions are siphoned from the market, penny by penny, trade by trade, into the hands of those with the fastest machines. Derivatives are even more dangerous. Financial time bombs, disguised as contracts, leveraged to absurd levels until the entire system rests on the assumption that nothing will go wrong. But it always does. 2008 wasn't an accident. It was the inevitable conclusion of a game played too aggressively for too long. Banks handed out bad loans, hedge funds bought insurance against them, and when the housing market collapsed, they didn't just survive, they thrived. They bet against the very financial products they had helped inflate. When the dust settled, the public had lost everything. Homes, jobs, savings, the hedge funds, they were cashing in their winnings. And yet, they weren't punished. They weren't dismantled. They weren't even slowed down. Because every crisis since has been another opportunity. The European debt collapse, the COVID crash. Each time the world panicked, hedge funds strategized. They bet on failure, exploited weaknesses, squeezed profits from disaster. And yet somehow, they were never the ones left holding the bag. Their wealth was protected, their influence intact, their losses absorbed by someone else. Because it's not just about the market, it's about the system itself. Hedge funds don't just play the game, they help write the rules. Political donations ensure regulation never touches them. Media connections mean they control the narrative. When they need a stock to rise, glowing reports appear out of nowhere. When they need one to fall, a whisper campaign begins. It's a closed loop of power, where fortunes are made behind the scenes before the public even realizes what's happening. For a brief moment in 2021, the system was challenged. GameStop wasn't supposed to be a battleground. It was a dying retailer, heavily shorted, practically doomed. But retail traders saw an opening. They squeezed the hedge funds, forced their hand, cost them billions. And for the first time, the game seemed to shift, until the system fought back. Trading was halted. Buying was restricted. The hedge funds, battered but not broken, were protected. The message was clear. This isn't your game to win. So where does that leave us? Are hedge funds the ultimate expression of capitalism, pure, ruthless, efficient, or are they something worse? Governments talk about regulation, but hedge funds are too big, too embedded, too powerful to control. Some say they provide liquidity, that they stabilize markets. Others argue they are parasites, profiting off collapse, gambling with the global economy. Because the real danger isn't just the money they control, it's what happens when they push too far. When their bets become too big, their leverage too high. But what happens when a true giant falls? When a hedge fund so entangled in global finance collapses under its own weight? Hedge funds have spent decades bending the market to their will, but every empire has its reckoning. Every unchecked power eventually faces its own destruction. The only question left is when the collapse comes, who will pay the price?